Hi guys, it's Millie and welcome to Let's Talk Personal Finance, the channel where we discuss how to make money and how to manage it. 2021 is the first year that I not only had access to credit, but actually utilized it. Now, I did this in two ways. So, the first loan that I got was a home loan, which I used to get an investment property that I'm still paying off. And secondly, I got a car loan that I used to finance a car, and I've since paid that off. And it's only after I got these two forms of credit that I realized the true cost of credit. So in this video, we'll be taking a closer look at the different factors affecting the cost of credit in hopes that this will help you make an informed decision when you do decide to utilize credit to help you reach your financial goals. But before we get into all of that, let us first define credit. Now, credit is the ability of an individual to obtain either goods or services using money they do not currently have. This is based on the trust that the money will be paid back by that individual over a series of payments that are made in the future. It's also important to remember that credit comes in different forms, such as personal loans, home loans, car loans, and even credit cards. So, the first cost of credit, which a lot of people are quite familiar with, is interest. And the interest rate is typically dependent on a number of factors. So it depends on the type of credit that you're getting, the repayment term, as well as your credit score as an individual. Interest rates can be either fixed or flexible. A fixed interest rate stays the same all throughout the loan repayment term, whilst a flexible interest rate changes and fluctuates in accordance with the repo rate. So as the repo rate increases, the flexible interest rate will increase and vice versa. The second cost of credit is called the initiation fee. Now, the initiation fee is a certain amount of money that you're required to pay when you get the loan. So this amount is paid only once at the beginning of your credit agreement, and it is typically proportional to the loan, which means the larger your loan, the larger the initiation fee you're required to pay. Now, the initiation fee can be paid in one of two ways. So you can either pay it up front, so you make a cash payment and you pay it once and you're done with it, or you can add it to your total loan amount. And then that way you'll be paying off the initiation fee in monthly installments as you're paying off the rest of your loan. Now, I remember when I got the investment property, we decided to capitalize our initiation fee, which means that we're technically paying for that initiation fee as we pay down the loan amount that we got. Now, the third cost of credit is the service fee, which you have to pay for on a monthly basis. Now, this amount of money that you pay is used to cover any administration costs that you have for servicing your loan. Now, in South Africa, according to the National Credit Act 34 of 2005, the maximum monthly fee prescribed in term of section 105 of the Act is 60 rands. So this means that any facility that can provide you credit can charge you a maximum of 60 rands as your monthly service fee. Now, of course, if you have multiple loan accounts, you have multiple loans with different institutions, you will have to pay a service fee for every single one of these loans. So if you have too many and you're not careful, you might end up paying hundreds and hundreds of rands in service fees alone. Now, another thing to note is that the National Credit Act 34 that I mentioned earlier only applies to individuals. So in my case, my brother and I got the investment property and we got the loan in a company. And currently, our monthly service fee for that loan is like 240 rands instead of the 60 rands. If we had gotten the loan as individuals, our maximum service fee would have been 60 rands. So that's another thing to consider when you're deciding whether or not to get a loan in your personal capacity or in the name of a company. Now, the last cost of credit is credit life insurance. Now, this is insurance that you typically get to ensure that your debts will be paid on your behalf in the event that you can't pay them yourself. So, in the case of death, or in the case of disability, or if you're retrenched and you no longer can afford to pay off your debts, credit life insurance, if you have it for that particular loan, will come in handy because they will then take over your monthly payments and pay off your debt on your behalf. Now, credit life insurance is not always included as part of your credit agreement. So it's always important to always ask the institution that you're getting into this credit agreement with whether or not the loan comes with credit life insurance. Okay, guys, so that's it for this video. I hope you enjoyed it. I hope you learned something. If you did enjoy the video, please leave a thumbs up. Please leave comments and please share the video with other like-minded folks. And remember, guys, you're never too old or too young to talk about personal finance. Ta-da!